Jyotivardhan Jaipuria, who's the founder and MD of Valentis Advisors, joining us now. Hi, Mr. Jaipuria. Good afternoon. Thank you so much for joining us today. Mr. Jaipuria, tell us, what are we looking at as far as the near term is concerned? Because if you look at the entire year, we were working with the rather lukewarm expectations or expectations of a lower return. But if you look at the macros now and how macro is shaping up, it augurs very well for India, whether it is the dollar cooling off, or whether it is the oil prices coming off, or the FII buying that's coming back to India. But there is a looming threat of the tariffs. There is an uncertainty as far as the US economy is concerned, and of course the Indo-Pak tension that's ongoing. How should one really look at these markets, and how should one be placing their bets?
Yes, like you said, it's a year where, it's going to be a year of low returns. In the sense that if you see the last 4, 5 years post-COVID, returns have been extraordinarily high. We had like a sharp re-rating of the market as well as a good earnings growth, which came both from top line increase as well as from margin increase. So, to that extent, markets need to consolidate. And we probably are going to see that consolidation phase in calendar year 25. Now, obviously, like you said, there's some things, the macro is turning very positive for India. And at least on a relative basis, India looking very good because one is oil prices have come down, which is giving room for RBI to cut rates. And plus, they're increasing liquidity in a big way. So we've seen very easy monetary conditions over the last 4 months. They put in like 6 lakh crores of liquidity in the system. So India is one of the few countries where we are getting that sort of liquidity coming, which is helping us a lot. But there's some global factors which are not in our control, like the tariffs which are going on the US. Our view is that probably the worst of the tariffs we saw on April 2nd. And from here, tariffs are going to probably get a little more sane. We'll see a lot of deals happening. And so, maybe 4 months later, we'll find that the tariff is not as worrisome. But in spite of that, probably you're seeing a global economy which is going to slow down. The US will slow down, a lot of other parts of the world will slow down. So India will have to fight that, headwind which they will see. Uh, of course, the India-Pakistan situation is tense, though my view is that we probably are not going to see that flare up in any meaningful way. So it's something which will pass. If we go back into history of markets also, you tend to see that every time there's a conflict, markets get nervous at the time of the conflict, but soon, markets get over with the conflict and, markets start to resume their normal space.
Good afternoon, Mr. Jaipuria. This is Shrishti also joining in. Yes, a lot many moving parts right there. And for the past couple of days, we are seeing that the markets are just holding that nervousness around, not doing much. But give us some sense, what strategy should investors adopt? Is it time to protect the capital? Or maybe it is a time, given the correction, that one can still start buying? And if yes, then where are the pockets? Which are the pockets that are looking attractive?
Yeah, so I think people have to buy today thinking of the next 3 years. Don't buy thinking of the next 1, 2 months. It's a time, like I said, to build your capital. And think of this now more like a test match, not like a T20, where we're going to build our portfolio for this year, and then we get the returns over the next few years. And keep your return expectation tempered, like what we got in the last 3 years may not repeat in the next 3 years. The other suggestion I would have is probably try and stagger your investment over the next few months rather than put it in one shot now, because there are a lot of, uncertain events. So, a staggering approach would work well. If some of these things don't go well, at least you have money to buy more at that stage. Some of the stuff which we like, for us, we typically tend to focus on valuations. We are very valuation conscious. We like to buy, sectors which are beaten down and which are not in favor. We generally don't buy momentum stocks. We buy probably, I would say, anti-momentum companies. So we like the banks still, and we were very early to call out the banks. We think that still continues to be a pocket where valuations are looking cheap. And if you look at, and I've said this on some shows earlier also of yours, but if you look at valuation in banks today versus what a 10-year average is, banks is probably the only sector where valuations are cheaper today than a 10-year average. So the banks still look attractive to us. The other segment which we continue to like is the pharmaceutical, but there obviously there's some threat that if Trump goes ahead with his tariffs on pharmaceutical, then there could be some short-term correction in this whole sector. But otherwise, it's something which is looking very good on a secular basis, on a 3 or 5 year basis. Pharma, something which is going to do very. Another sector which in India looks good is the cement sector. So we've seen, cement prices start to move up finally after a long time. It's a sector which has got consolidated a lot relative to what was in the past, and the top two and the top five players account for the large part of the share. So I think it's a sector again which over the next 2 years could be a great way to play. So there are pockets focus on valuations and focus on where visible earnings growth are, and you'll find some sectors where you make good money in the long term.
Right, Mr. Jaipuria, as you rightly pointed out, banks is a pocket where you see valuation comfort. You also pointed out that pharma, where you see growth coming in. But besides that, let's talk about the broader market then, Mr. Jaipuria. Despite the correction, the SMIDs are still expensive, especially the small caps are still expensive. So usually, one would like to invest in small and mid caps for value generation, for value creation. How would you place your bets in those pockets? Is it going to be a buy on dips? Is there a valuation comfort in the sense that on every dip now, can you stagger your investment as far as the SMIDs are concerned? And within that, what are the pockets of value? Because there are certain pockets that are still expensive right now.
Yeah, so when you look at the small and the mid cap, actually it's the mid cap which is more expensive than the small cap. The small cap is still a little better placed relative to the mid cap. But very often when we look at the aggregates, when you compare small cap probably with the large cap or with history, uh, then it is looking expensive. But what goes for the small cap is the growth. So the last 1 year earnings growth was weak in the large cap as well as the small cap or the mid cap. In general, earnings growth has been weak. We think that the earnings can recover. So if we can get that sort of recovery coming in earnings growth, which analysts are forecasting today, and if you take like a consensus analyst forecast, uh, for the large cap, the earnings growth forecast for the next couple of years is 12%. And for the small cap, the earnings growth forecast is 22%. So if these earnings hold and the earnings actually come in line with the analyst forecast, then you'll find that the small caps have done decently well relative to what we are thinking of today. The other is like when you look at sector by sector, there are a lot of small companies which don't look as expensive the large cap, though the aggregate everything looks more expensive because obviously in the large cap you have a lot of public sector companies and all which are not represented in the small cap index. So on an overall basis, the large cap is looking cheaper. But when we go sector by sector, we find a lot of small companies which probably can grow faster than the large cap and which do trade at reasonable valuation. The third thing is, of course, we've seen a steep correction in the small cap. So if you see since the beginning of this calendar year, small caps are down and they were down like 20+% at some point. They've recovered a bit of it. They're still down like 15% since the beginning of the year. So you have seen a correction. Probably a year later, we'll think of this correction as a buying opportunity. Means, we've done some analysis, and typically the highs of the small cap tend to come, in the next 12, 18 months, unless we have some Lehman sort of event. So in some sense, you can expect the highs to come back over the next 12, 18 months, and that will make you reasonable money. There are valuations are not cheap still, right? Like you rightly said. So I would say stagger your investments in small cap. Don't put everything in one shot. Be ready for some drawdowns and don't panic at that time, but use, the rest of the money you have to buy more at that time. But over the next 2 years, if growth in India holds up, then I think, small cap will give you good returns.
Let's watch out for that small cap. Maybe a new high is likely over a year period of time. But Mr. Jaipuria, given the fact that now in the US, the market is really open to make trade deals happen. And well, of course, we will be watching out for the final trade deals as Donald Trump has already indicated for one. But give us some sense that if major nations goes through this trade deal sort of a thing with the United States, do you believe maybe it could be a time to once again look out for some beaten down commodities, beaten down export-oriented names?
So, one segment which we've been nibbling into has been the chemical sector. So if you just step back and think chemical sector done very badly over the last 2 years. And the positive for us is that, there was a lot of excess stock lying at the dealer level. in the chemical sector. That's stock has drawn down. So now, the situation is much better. Demand is picking up a bit. And at some point, if demand picks up, then the dealers will start to destock rather than destock, which they have done so far. So, second is the valuations have become much cheaper because these sectors have underperformed quite a bit. So it's a sector we are nibbling into. Now, US tariffs do make a difference to this sector because, if US tariffs are very high, then probably the US market get blocked off. So if we can get a trade deal done there, then I think chemical is one sector which one should focus on. And there are valuations which are now starting to get attractive. Not all of them are very cheap, but at least they're starting to get attractive and growth will come back in this sector.
Mr. Jaipuria, with this, we let you go on that. Thank you so much for taking the time out and speaking with us this afternoon. But sticking with the theme of commodity, we spoke with Dr.
If you like this video, then like, share and subscribe to ET Now.